All right, folks, welcome back. This is our weekend commentary for the ICT mentorship for the 1st of October, 2021. All right, so we are looking at the dollar index. This is our daily chart here. And I mentioned that we could see a down close candle, maybe retrace back into this, but I don't want to see it completely close back that buy sign imbalance, sell sign deficiency. So we've created a low on Thursday, and then today we went just a little bit deeper into that. Now, going into Sunday, what I'd like to see is it not go any deeper to close this up. Now, can it go one more time into that and go higher? Yes, but I'd rather it not do that. I'd like to see it open a little bit higher, fail to go lower than Friday's low, and then start working towards a run into this high. That's what I'm looking for, and that's what I would favor over anything else. Now, if we do trade back down in and rebalance this here, in my mind, it's a little less bullish, at least for the near term, and it may need to come back with a deeper retracement, which makes it a little bit more difficult again. So hopefully you can see what I'm trying to outline here in terms of preferring a specific criteria in price action. And if it were to completely close this in, I would sit on my hands and wait for more information. All right, here is the hourly chart for the dollar index. You can see we've worked on that level, the old high, short-term high. Is the other high is obviously above this one, but this consolidation around that old high is typical. You can see it wants to trade back down into all of this run here, but again, I don't want to see it come all the way back down in, and I don't want to sound like a broken record, but to do a deep retracement in this, in my mind, would welcome more of a decline to take us into this. Okay, so I'd like to see it open higher, come back down, find some support here on this imbalance there. That'd be a good little short-term discount level, and then see if it can make a run into that 94.50 and then reach for higher prices as a result. And the 15-minute time frame, again consolidating around that old high. Nice optimal trade entry here on a TDIF scenario. Small little fair value gap in here, trades up into that, sells off, rebalances to this CIVI, and consolidates into the close of the week. Now again, so that way we understand each other, I prefer not going any lower on Sunday into Monday. If we do go lower and dig deeper into this over here, I don't like that. And as some of you see that fair value gap right there and this order block right there. Can it go down to that, hit that, and then find bullishness? Yeah, but I'd rather leave that open. Remember, we want to see imbalances stay open because it helps build the framework around market structure, and we can trust these levels can indicate, if you will, the underlyingly bullish, or in this case, bullish scenario for dollar index. If it comes back down to fill this in, to me, it welcomes more of a longer term consolidation or going lower. That's how I would interpret that. Eurodollar daily chart. Okay, we got our up close candle in here. This down here is my intermediate term target for Eurodollar. Can it go a little bit deeper into here? Yeah, but again, I don't want to see it come back to this old low. To come all the way back up there, just in my mind, it's better to leave some of that open. Don't rebalance all the way up. Hourly chart, Eurodollar. Small little retracement today. Back to the old low. All right, 15-minute time frame on the Eurodollar. This in here, I was watching this intraday, and I thought that we would punch up into that and make a run for that buy-side liquidity. If it would have done that, that would, in my mind, set up a really good scenario for selling off on Sunday's opening into Monday's trading. It didn't do that. So watch that scenario as a possible setup, something to study I'm not trying to push so hard that you would go in and short Eurodollar on Sunday. But just watch it. See if it can get up there. If it rejects that 116.10, 116.15 area, maybe even spike up to 16.20 and then reject. We left these really nice, clean, relative equal lows. Lots of buyers are going to have their stops right on here. They're trying to catch the low on Euro. So that makes it a real juicy level to go to after it induces everybody into chasing longs. And nothing has indicated that we've turned the corner on Euro going lower. Pound dollar, daily chart. And a nice run right back up into the old low here. Don't want to see any of this up here close in. Okay, so this is ideally left open. This is traditional return back to an old low. I'd rather do nothing like that, preferably, but you know, you can't get what you want. It's not Burger King. So, not that anybody really should want Burger King, but that's their slogan, have it your way. But returning back to that old low, it needs to shake that off and, or preferably, consolidate in here and allow Eurodollar to catch up with what pound has put in place for its decline here. And that would also further increase the likelihood of Euro pound dropping. And we'll talk about that when we get through cable. All right, so pound dollar, hourly chart, imbalance in here. Buy sell liquidity. So they rammed up into that today. Really nice run. TGIF setup. And again, TGIF, you can do a search on the forum. In the upper left-hand corner of the forum headers, it'll have a search tab. You click on that, type in TGIF, and it'll take you to any area on the forum where I've commented about TGIF. And there's a few commentaries that one I introduced it, and then a couple other times where I've mentioned it. But it's not mentioned in any kind of like monthly content. It's taught specifically in the commentary videos. So anyway, we went back to a short-term premium, relative equal highs in here. Buy sell liquidity taken and back into the imbalance there. So that to me sets up a possible scenario for institutional order flow entry drill there. But I don't want to see it sell off quick. I want to see it kind of like consolidate and then let Euro dollar decline. Pound dollar 15-minute time frame, again, just a really nice run up. Sell side liquidity rams up in, takes out buy side here, back into the old low. Just a amazing, really, just a complete run right back to that old low. That looks real bullish to a retail trader. That looks like, you know, I'm going to get on that train and see if it goes to 140. They start looking at, you know, unrealistic objectives. This, I like it on the end of the week because it sets up sentiment all over the weekend. Everybody's going to look at this and say, I want to be buying pound dollar. And I like that scenario. They set a lot of bait out for that, and they left relative equal lows here. So to me, I'm going to interpret this as they're running into a premium to attack this later on in the week. Euro pound daily chart. We're only going to look at this time frame. I don't need to go into any other time frames because I mentioned this the other day about how we ran this. That's what set up my remaining balance on the trade being stopped out. So it wasn't a losing trade. It was just the small balance on the short got stopped out as it ran above these relative equal highs. And then later on, obviously, I revisited this market in this particular pair. And I said, I think that we basically went up here, swept this out, and we want to see it trade aggressively and reject all this and dig into this candle and kind of like overcome it, really. We didn't want to see any kind of bouncing or stagnation in price at that opening price. So don't treat this as a bullish order block. Look for it to get completely railroaded. And we're getting that here. So that's kind of nice to see that. All right, that brings us to our gold homework. And I gave you this chart here. Now again, folks, if you're not doing the homework, if you're not marking your charts up and looking at things before I go over these, you're kind of like stealing the whole thunder from this portion of the mentorship. Otherwise, it's going to feel mundane. It's going to feel, why am I even doing this? I could do this on my own, that type of thing, which is good. You should be doing it on your own. But to force individuals in the mentorship to go into the charts, digging in with the logic, and also pulling out enough for a model, but not trying to throw every single thing that's available in the mentorship in every single setting. Okay, so that's really the focus of what I'm showing you. I get a lot of emails from new students in the 2021 final group. They're saying, look, man, this is a whole lot more than I expected to learn. Like, this is a lot. And yeah, it is. There's a lot more. But you don't need to apply every single thing you're learning. In fact, you're going to find that not every single thing applies. But the things that do appear in the chart, you have to weigh out whether or not is that part of your model. And do you really need it? Do you need COT? No, you don't need it. Do you need the market to be in a premium market or a carrying charge market? No, you can trade either one. One just has a better likelihood of going parabolic vertically up when it's in a commercial bull market. You don't need to trade TGIF. Okay? There's so many things that are just ways to improve or make specific your approach to going into a setup or a condition. Don't fall into the thought process that you have to try to force every single thing you're learning here into every single fractal in price. Like, everything that's being taught to you will not always have a place in the portion of price action that you're studying. Okay. I'm going to show you also tonight, we're going to touch a little bit on market maker buy model and sell model, more specifically the sell model. But for the homework here, if you haven't done the markups, if you haven't looked at the lower time frames, if you haven't gone through any of this, please stop the video and go through gold. Look at your daily chart, focusing on this high to this low, and break all that movement down, okay? And pull out the things that's most salient to you. And I'm going to cover, obviously, what is most salient to me. And then you'll see that there isn't a necessity for everything to be placed in here. And you'll see also some advanced teachings on the market maker sell model. So last chance, pause the video, stop it or whatever, if you haven't done the work on this. Otherwise, it's going to be a waste. There's so many people, they don't care this. I gotta watch it. I gotta watch it. I got my potato chips, and I got my bonbons and my root beer in my hand. I got my coffee. I'm gonna watch this video. I don't care what ICT says. All right, anyway. The daily chart on gold, what I've done here is I've taken your attention to this area here. We have relative equal highs. So you know what's resting above that, right? Buy side liquidity. So on your chart, you should have buy side liquidity here. And it runs up into that, and then it rejects that. Now, it's not important for you to be able to catch this as a short. You'll do those over time. But you'll fade those types of moves, like I just did recently with the Eurodollar, and I'll put that on the YouTube channel. That type of trade, you have to understand what you're doing, and it's really unrealistic for any of you, even in your first or maybe even your second year, to feel confident to go in and short while it's railing against, anyone that would already be bearish and it's just going straight up. That's a hard thing to do. It was very hard for me to learn how to do that too. I think realistically, any of you coming in here thinking that even though what I'm teaching is sound logic, it takes a lot of time to grow into that. And lots of charting, lots of practicing with a demo, and knowing what you're looking for. And don't be fearful. That's not even really the word I'm looking for. Don't discourage yourself. That's more appropriate. If you feel apprehensive about looking at these types of moves and thinking, you know yourself. Many of you in here, I would probably say 99% of you would be afraid to sell short on that run right above these relative equal highs. But you don't need to do that. Many of you are finding out that if you see that, you're thinking, okay, I would like to believe I could sell short there, but I don't have the courage to do it. So I'm going to wait and see what happens. Well, when it does this, and then it runs and breaks market structure, below this low here, then what do we have? We have a bearish order block with this candle here, and then we have the sell side imbalance, buy side inefficiency there, and breaker, that candle right there. So I didn't want to add too many lines in here, but on your chart, you should have this as a breaker. You can, I guess, use a rectangle or another colored trend line. But this sell side imbalance, buy side inefficiency with the breaker runs right back up into here. Man, that is such a strong, strong pattern. That is so strong. If you look for that throughout the intra-week trading, like 15-minute time frame, 1 hour setups, man, they are so good to give you bread and butter setups. And many times, if you have the weekly profile mapped out ahead of time, looking at the economic calendar, anticipating what you think is going to happen between Sunday's opening and Friday's close, if you dial yourself in really well, you can use this very pattern here to nail down very close to the weekly high when it's bearish. You don't need the actual weekly high. Now, I teach you how to get that, obviously, but the point is you don't really need that. You need to know that it might do it there, and let's see what happens. And when it breaks down, bingo, you got institutional order flow entry drill here, or the breaker. Now, you might have the bearish order block here, but don't demand that. Okay, now there's going to be times where I say things like this and it's going to sound like I'm cherry picking logic because I had the benefit of hindsight. If you're going through the course and you're writing down notes, and when I'm talking about breakers and I'm talking about imbalances and coupling those two together, you're going to hear me say what I'm saying here. So it's not like just me pointing to this saying, oh, this is where it works, so I'm going to sound smart in front of you. This low doesn't really get traded to. Not in the sense that, you know, the opening price, I like to see that when it's a small little butt right there. That, to me, I'm going to go with the opening on that and not so much the low. Because I'm going to expect it to be really refined and get that opening price. Now, it might fail to get up into that opening price and just react on the low. And that's okay. I mean, but we're not talking about a whole lot in terms of pips there or points in regards to gold. But if I have an imbalance like this and a breaker, I'm not going to go to the order block that's bearish. I'm going to focus on the bearish breaker. So if there's a question of whether or not you would use a bearish breaker over a bearish order block, if it has this scenario here, okay, this signature, very important for your notes. If you're not writing this stuff down, put your chips down. This imbalance with the breaker after a stop run, I do not need it to go back to the bearish order block. I'm going to use the breaker, the low, or the opening. If I have a little tail here, you know what that means, right? The opening price to the low, split that in half, find consequent encroachment, extend out in time. Hallelujah. Can I get an amen? There it is right there. So we have institutional order flow entry drill, bearish breaker. We don't need all this to fill in. In fact, what do we want? Leave it open. And we don't need that order block. Now, everybody on YouTube's thinking, okay, this is a FU candle, which doesn't exist. They're all made up terms. This bearish order block doesn't even get traded to. You missed the boat because they don't understand the logic. This is what I'm referring to when I say being in mentorship, you're learning and you have lots of things to learn still about what makes these things work. When you see me demonstrating them and it looks like, what is going on? I'm in there at the highest candle, getting out the lowest candle. How am I able to do that? It's the logic. It's the things I'm teaching you here. That's mentorship. You know, I have a lady in mentorship now, and I'm not beating you up because you know who you are. Send me an email, said, I'm going to stop mentorship at month 9. I think I've found out how to trade now. I've learned a lot. Thank you very much. Wow. Okay. I don't understand how many people go to. I've had people come all the way up to month 11 and say, you know what? I'm going to stop here. What? Like, even when I had no charter membership payment, like in the first group, I had people go all the way up to month 11, and there was no charter conversion charge back then. Like when at the first year, it was nothing but just the 12 months at 150. That's what it was back in 2016 going into 2017. And I had so many people go all the way up to month 11. All they had to do is make one more payment, and they never had to pay anything ever again. And you all know that from the 2016 group. You're still here, mooching. Now, you know it's part of the terms. You don't have to pay anything. But every year or so, when I was building more server needs, and it became more expensive, obviously. So I wanted to offset all that. And the charter membership had a fee, obviously, that went up a little bit more each year. And I said this in the beginning. I would only increase it if it was more cost for me. And obviously, I'm so many people now, and the server size is this ridiculous. But to hear someone say, or to read someone say in an email, like I'm going to go up to this point here, I'm not going to go any further, doesn't make any sense to me. Like, that makes zero sense to me, unless this person obviously was one of the individuals that were offended by me going after both the Democrats and Republican slant. And if that's the case, then obviously you do what you got to do to have mental stability. And if you can't be in my house because I'm telling you what I see and how I think, and you don't have to agree with it, but it's just, to me, it's astonishing to see how many people literally have gone so far in mentorship, and then I'm sure a lot of them find things being leaked in here and there, but that only helps you so much. Like, they don't even have everything. Nothing. They have introductions. All these videos and these monthly lessons that you get, they're just like watching an infomercial. Okay? Remember the Slap Chop? The guy's up there, you're like, look, come in here, let me show you this, and show you, he's chopping this and chopping that up. Okay, what is he selling? He's selling this device that is supposed to chop up things, okay? But you're more busy watching his banter and the things he's saying that's really comical. You forget about what he's selling, and you're just watching the entertainment. That's what happens when people see my videos outside the mentorship. They're entertained because, wow, I can see what he did there. And they think right away they can go out and do that in a chart. But they find they can't do it, so they make a name for themselves selling hindsight. Now, when I'm talking about lessons like this, the weak-minded individuals, the very critical individuals that probably are never going to be profitable traders ever, will say, well, you're doing this right now with the way you're teaching now. But this is exactly how I learned how to see these things repeating over and over again. There is a large group of this mentorship community that is still very lazy. They don't do anything unless I'm doing it in the chart for them. And then they send me emails saying, hi, I got a funded account, and I just did this and did that, and come to find out they were literally trading against the bias that I share in the commentaries. And they said, well, I don't really watch the commentaries. Wow. Wow. Like, that's the whole point of being in mentorship. Like, I'm guiding you. I'm helping you navigate. So hopefully, while it's not a signal service, I'm helping you see what you should be aiming for downrange. Where's the market likely to go to? I don't want you just listening and thinking, yeah, he's telling a story, or this doesn't apply to me because I don't like this market. I don't trade the index futures. I'm never going to trade gold. I'm not going to trade this time frame. If you think that way, okay, if you're thinking that as I'm teaching, you are really stunting your growth. You absolutely are hurting yourself in how you can grow in your understanding about price, because the time frame is irrelevant. The logic is what repeats on all time frames. So just tossing that in there for no extra charge, but the mentorship is me teaching you the principles and the logic behind why price is doing what it's doing. And this is the very reason why I can do the things I can do when I'm executing, not talking about hindsight. Okay, so again, have this in your notes. If you have a breaker that runs buy side and the imbalance that happens after that, I'm not going to reach for the bearish order block. I'm going to use the breaker and not require it to go up into. Now, where would a stop loss be on something like that? If you want to sell short at the breaker and it has a run into buy side and it creates the bearish order block and you're not going to trade the order block and you're entering below it, where would your stop be? It needs to be above mean threshold. So the midpoint of that bearish order block, your stop has to be above that. It doesn't need to be all the way above here, but it definitely needs to be above the midpoint of this bearish order block. Okay, so that would be a nice entry there, and then it sells off and creates another sell side imbalance, buy side inefficiency, which gets rebalanced pretty efficiently back into the consequent encroachment of this candle's tail. Split that in half. Boom, there you go. Sells off, attacks the sell side liquidity here, and then makes one more run back in for an institutional order flow entry drill there. Then sells off and attacks the rejection block. Now here's where we get a little bit more advanced. Oh, some of the chart members are buzzing right now. Finally, this guy wants to teach something new. There's all kinds of new stuff in here. You just are looking for something from a different persuasion, something with a little tang in it. Okay, this is going on the basis of a market maker sell model. Do you see the sell model here? Some of you are looking at this, and that's one. That's a very large one, but I'm talking about here. What is this? That big tail. That is a stop run. It's running over here. Now, this run into all this structure, this can now be eliminated for the purposes of using a market maker sell model, because this is manipulation. So manipulation is an event. Okay, it's not a structure in price, it's an event. So a stop run, once it occurs, we can cancel this out in the chart. Pretend it doesn't even exist anymore, because that event has already transpired and it no longer holds the same significance that it did when it was occurring. Now, it doesn't mean completely eliminate the consequent encroachment. That's obviously, something of importance. But here, we don't need to go all the way back down here. Why? Because it's already done a deep dive into all this over here when it did this run. And then the next candle, it tried to go deeper again. Or I shouldn't say it like that. It tried to go lower again from the opening, but it failed to make a run even into consequent encroachment, which would be the open to the low, that midpoint. So it didn't even get to that. So how do we use this? Well, this is a stop raid, and this here, this little tiny little tail, forget that. What do you see in this area? Do you notice how the bodies are real close to one another? You got a little tail here, a little tail here, and a large tail there. The bodies are telling you the storyline. The bulk of the volume is there. This was a stop run. Forget all that. Forget this tail here and forget this tail here. Okay, look at the bodies. See that? That's why the rejection block is powerful, because it cuts right to the chase of, even in these instances like this, it takes you right back to what the algorithm is going to refer to. Now I'm teaching you the importance of why you disregard these big runs and these big wicks, okay, or tails in this sense, and go back to the bodies of the candles, because that's where the volume is. Now, if you were to look at it from that perspective, not looking at any of these tails here in the candles, we have bodies here, We run up, accumulate, reaccumulate, smart money reversal, low risk sell, distribution, redistribution. Where does it go? Right back below the bodies of the candle. See that? That's stuff you don't see on YouTube. Nobody in Wyckoff would ever see that. Supply and demand wishes they could have this kind of logic in their trading. It's just not taught anywhere else but me. I have never revealed it any other time, ever, ever, ever. This is the first time. Now, when I say that, why am I making a big deal about it? Because I know there's a whole bunch of you that have YouTube channels. I know there's a whole bunch of you that have Telegram channels. A lot of you have Discord channels. A lot of you have your own little signal services and all that other business, okay? When I see these types of teachings get put in your own words, I clam up. And you'll have just what you get, and I'll just teach from what's been shown thus far. We're getting ready to go into more logic and more things that really help you understand the markets. Don't be a fool and want to run out to the society out there at large and say, look how smart I am. Because you can talk about it in hindsight. They're all going to know you learned it from me. But you can't do it until you can do it. Too many of you young guys in here are in a hurry to get fame and attention. It's easier for you to learn how to do it correctly, get funded, make money, and do that. Don't disrespect my willingness to teach this stuff, because it will be very easy for me to say, nope, I'm not going to go any further. And you all can be mad. You all can be offended by that. And I would understand, yeah, that's upsetting. But that's my only recourse. And I don't need to teach anything new. I don't need to do that. I want to, because I can't wait to have the reactions you guys share when you're like, man, that's crazy. I never would have saw that. Right, you never would have saw that. But you all can be millionaires from month one content. That's enough for you to get rich. Just apply sound money management, good dose of patience. Every single one of you can get rich on month one. That's why I made that month the way I did. You come out, you hit the ground running, boom. And that all really is Baby Pip's teachings that I gave, not Baby Pip's teachings that they taught, okay? The Baby Pip's videos that I gave out for free. All those teachings and things that I did were just basically consolidated into that month one. That's all it is. Elements of a trade setup. If you would have been listening and reading and taking in all the information I was teaching when I was contributing on Baby Pips, you would know everything on month one. But surprisingly, when you watched month one, it was like, wow, this really makes sense. But all that stuff was taught on the videos I did when I was on Baby Pips and the early YouTube series that really I don't have up anymore. But anyway, let me get back to the lesson here. So we have the consolidation here that starts there. So the rejection block basically does enough for us for that there. Manipulation, once it's done, you don't need to focus all that much on it, but just every time you have a big wick or a tail, focus on consequent encroachment, because that could be a revisited level. We don't need it in this sense to go down there. Why? Think. I've already outlined the fact that the bodies are telling you that this is the original consolidation. This is just a stop run. Treat that as the original consolidation, where the sell stops would accumulate, just below there. Not down here, because it's already done that. Not below here, because it's already went down there. It only needs to go below these bodies. That's it. Now, ring in the market maker sell model. You run away higher to what? Some kind of premium array. What would that be? A bearish order block, an old imbalance, relative equal highs. Well, there you go. We have those. The market runs into it there. Now, once it hits that, you do not need to be the superhero that goes in and sells short right there. Your goal is to eventually see that and be able to do that. But what happens if you never get to that? Can you still be profitable? Yes, absolutely. In here, this might be your first entry, not using the low risk sell up here. This might be your first level of distribution. It makes sense to you. You can do that. This one is the absolute easy trade. This is the easy one. Remember, it's the second level distribution in a market maker sell model. I just recently taught this, I think about within the last 5 or 6 weeks I talked about it, I think. That right there, that is the easiest thing to trade for price action. But we're focusing here initially. So we trade up to the breaker there, or use institutional order flow entry drill. One or the other, doesn't make a difference. And it sells off. Then we have consequent encroachment of this candle's tail. Trades up into that. Hits it. Optimal trade entry. There. And then attacks what? The sell side resting right below here. That's what the algorithm is going to go for. It's not looking at this like everybody else is. It's looking at the bodies right there. And specifically the projection block. So selling short here and targeting right below that low, that's enough. High odds, high probability. You are in sync with the algorithm. So you have a sell here, and another sell here. Why is this a sell? Because we haven't gone to that liquidity yet. 4-hour chart, we trade up into the buy side liquidity pool, relative equal highs. Break down, mean threshold. Last up close candle, split the range, bam, low risk sell. Why is it a low risk sell? Because it's already done the work here. If it's going to drop, you can put your stop loss just above that high there. Very, very small stop. And then aiming for what we showed on the daily chart. So the market maker sell model here. Low risk sell, distribution. Candle drops here, next candle opens, goes above it, and then slams down, creates the imbalance right there. Notice how we have 1 pass, 2 pass, 3 pass. Let me say that again. This candle right here opens and trades down, so there's sell side delivery. The next candle opens, trades up. This area here is balanced. Then it comes back down and offers sell side again. Notice that? Opens, trades down on this candle. Opens, rallies up, rebalances, then sell side is offered again because we went below the opening. So this area right in here is a balance price range. That's going to act like a brick wall. When you have an imbalance, that's how you know that you don't need to come up to this area right here. Oh my goodness, look at this guy. And you're giving out all kinds of gems tonight. Yes, I am. So the balanced price range here acts like a barrier to not needing this to be rebalanced, which makes this what? A breakaway gap. Oh my goodness. Oh my goodness, I got butterflies. This feels so good. I can see this now making sense. Right, isn't it awesome? So this balanced price range with a imbalance right below it, it comes right back up, hits that, rebalances, and stops. Go no further. Why? Balanced price range. We've already went back and forth here. There's no need to go back up into this area. What happens if it does and trades back up to here? Is that a sell? No. That would be jeopardizing this high, and I would take the short off and save my stop. Wow. Find that in the book. It's not there. Wyckoff doesn't teach that. Sorry, Larry Williams doesn't teach it. Chris Laurie probably doesn't know anything about it either. So we have this area here, rebalances, and that's your first level of distribution on the market maker sell model. Steve Morrow never learned that. Sorry. The market drops aggressively. What's it attacking now? It sells out liquidity here and below here. See all that? Aggressive run. Where's the liquidity at we're aiming for on the daily chart because of the market maker sell model? It hasn't been reached yet, has it? But look what it creates here. More decline that's aggressive, and the imbalance trades right back up, hammers the midpoint or consequent encroachment. You can't really see it here, but I'm not going to go back up to the daily chart, but you'll remember what I referred to in that consequent encroachment wick. Hits it, taking buy side liquidity here, rebalancing that small little portion there. Why didn't it go up here and rebalance to that? Because we were on a higher time frame daily, and the consequent encroachment level is here. Hammers it, breaks down. What do we have again? Highs, buy side above it, low, higher high, breaker. Trades up into the breaker and mean threshold of the bearish order block, because there's not enough of a gap and range separating the breaker and the high of the bearish order block. So you would go right into the mean threshold of the bearish order block and the breaker, which is this right here. I know you probably can't see it, but when we drop down lower time frames, it'll make more sense. So we trade up into mean threshold there. Optimal trade entry. Sells off. Liquidity below here. It tags it. What's it create here? Bearish order block. Sell side imbalance, buy side inefficiency. Runs right back up to the bearish order block and then rolls over and attacks this area of order flow. Does it take the liquidity out? For the rejection block, yes. Rallies back one more time. Small little return back into this area here. Rebalance. And then stabs down into the run for the end of the market maker sell model. Then it sharp response. Notice that after it completes the market maker sell model, then you get this reaction here. Pretty neat, isn't it? So on the 4 hour, I'm zooming in a little bit better. You can see more detail right here. Beautiful run right back up into that. Consequent encroachment of the wick on the daily chart. Mean threshold. Imbalance. It returns back to that. This is an optimal trade entry too. And returns one more time here. Then breaks down. The 4 hour chart, I want you to take a look at the areas where the old buying now becomes the area of selling, or accumulation becomes distribution. Old accumulation becomes distribution. Old accumulation becomes distribution until we get to the area where it's going to target. So when you look at something like this, it removes the confusion about looking at support and resistance. Okay, so my question is, which of these lows in here do you draw a trend line from across your chart and expect it to turn at? Because that's the stuff I did when I was trying to be a fledgling trader in 1992. And it just never worked for me. Now, obviously the books are written in the sense that they already have hindsight at their disposal. And every single one of these lows, if you look at it, they all have some kind of failure to some degree. And there isn't that turning point here. Oh yeah, well, it has a reaction there. But then what happens? It comes right back up and knocks you out. Would you have reshorted it there? Probably not. But using the logic I'm teaching you, this is where you would expect the price to return back into, because why? Markets go down to be accumulated, to go higher. Markets go up to be accumulated, to go lower. It's accumulation distribution. In between those two elements of accumulation and distribution, there is an element of consolidation and manipulation. So you have to know where you're at in the delivery of price and then refer back to them. In this sense, like we have a market maker sell model here. This down closed candle is accumulation of longs. But when we go below it over here, it becomes mitigation here. So they accumulate here, runs up. What happens if they hold on to it too long, they can't get out, and they don't get out in time to take off profit? The algorithm is written in a way that they are allowed to do that unwinding here. They may take a little loss, but it's not as bad as it would be if they didn't have these opportunities. So mitigation takes place here. It's not the buyers took it from here up here, and then the sellers took it from here down here, and they're selling it here to make it go down. That's not what's going on, folks. The algorithm is doing all these things, and the traders that know what they're looking for either are participating in these moves or missing them. Interbank traders can miss the whole thing here. They can mess up. They can come to the screen and just be off. Psychologically be depressed, drunk, impaired, mad, sick. All these things that any of us would have an issue with, they're human. So if they are not reading it properly and looking for the things like you're learning here, they can't trade effectively and they won't be profitable. For you to sit back and think that retail and all the other traders around the world, okay, are doing these buy here, stop buying here, sell short here, go down here, stop selling short, buy there, sell short here, buy here, cover shorts, go long, stop, short here. Listen, that's fairy tale stuff, okay? That's fairy tale stuff. There is an algorithm that controls the ebb and flow. When you see this decline here to here, it doesn't need a lot of size behind it because the algorithm's doing the printing. It doesn't make a difference. It's like a demo. Think about it. This is why I teach in a demo and laugh at everybody else, because literally the same mechanism that's driving the demo is driving the real marketplace. And the asshats out there that make this big to-do about, oh, he can only do it in a demo account. Really? The same things that's making price go up in a demo account and go down, is it buying and selling pressure that makes your demo account price go up? No. There's no volume. The demo account is nothing but reflecting price. What is it doing? It's showing you what the algorithm's doing. But 99% of the people out there don't even acknowledge that there's an algorithm driving price. They just look at it as it's pretend money. And they choke on it. And they can't get past that. And that's why I'm laughing at all these people all the time. Because it's staring them right in the face. They have no idea what the hell they're talking about. And I'm showing it to them, proving it to them, that these things are autonomous. They're just completely driven by AI. Think. These things happen whether you're buying or selling, whether large funds are buying or selling. It doesn't make a difference. That's why markets can show a big spike up, and you can really see this with like futures markets. The market will run up to a specific level, clear stops, and the volume be very, very light. Really. You would think that it would be big volume, lots of trades that create this big drive up here. And that's how you know these yahoos on YouTube have no idea what they're talking about. Because they'll say, there's a lot of buyers that come in and the smart money buys it up here and it pushes it up there. No, it does not. That's not what happens. And when you see these people, feel free to go into their comment section and say they have no idea what they're talking about. Markets do not book like that. Period. The algorithms will run up and offer this price here. It does not matter how many people are actually going in here and buying. This price is going to be offered, period. And if anybody comes in with a market order, that order will print at that price. But the algorithm is offering that price regardless. Hello? Regardless. Turn to your neighbor and say, he said regardless. That's how this stuff works. That's why you have to have an understanding of narrative. Why should the market do what you anticipate it doing? Not pattern's sake, not logic and theory and some hero that wrote books, not some guy that has all kinds of cartoon figures and animal patterns and harmonic this and supply and demand that. That's all a facade, folks. It's all gimmicks. And when you strip all that stuff away and say, okay, if these banks, these central banks, are really in the business to make money and their whole MO is about controlling everything, and they do everything, why in the hell would they offer the chance of failure with just buying and selling pressure? Because they could sink currencies and global economies that way. We could do that. The general little John Q. public could do that. Kind of like what these folks are trying to pretend over there on Reddit with GameStop, BlackBerry, AMC movie theater stocks. I'm telling you, folks, the people that run these markets are loving it because they're literally chumming the waters for them to just destroy them. You're not going to turn these tables over, okay? You're not going to go in and turn the rules around on them. It won't happen. It will not happen. This is why I say the algorithm will not change. Everything will crash. Everything will crash. Period. Every asset class will crash before they would ever change anything about it. They only have to go in and manually override the things that's already programmed in these things very infrequently. There's so little time for them to have to worry about babysitting it. It's a free money operation. It just does what it's designed to do. There's nobody needing to babysit it. Why the hell would they want to change it? It works perfectly. It leaves so many people out there thinking that somebody out there got me, or some random spike happened in the marketplace, or some news event screwed me over. That's how you know someone has no idea how these markets work. And in some point, it's sad because I used to be there and used to be there too before you came here. And there's still some people in this mentorship that do not believe there's an algorithm. And I don't understand why they would have that view, but they are. They're just hardcore contrarian. I'm even fade-eyed CT on that. Okay, whatever. They're not profitable, but that's what they believe. And you're welcome to believe whatever you want. But you can't fault me for telling you what it's really doing, because that's what you came here for. And when I teach it to you, you have the choice. You accept it or you don't. Period. But don't complain or wonder or send me emails, hey, I used it to make money. I got funded. And then I got greedy because I needed to make money because I lost my job. And now I only have this much money left and I'm afraid to take a trade. You're not doing what you're supposed to be doing. It has nothing to do with the algorithm. You messed that up. So there's all kinds of ways you can bring in your toxic thinking, and that will erode your perception about what I'm teaching you. And that's exactly why these people in the world will put a thumbs down on a video that I put out that gives gold, or they can't do it and they're mad because I basically thumb my nose at them in the video, or I'll refer to it later on, and they get mad and they go back and they hit the thumbs down because it hurts me, and they think I'm smiling. I'm smiling at that. I love it. If it bothered me, I wouldn't even let it be visible. I do that because I know there's going to be a guy that hasn't even watched the full video. In 2 minutes, he's a thumbs down. And they can't wait for me to put another video up. They love me, okay? So this whole business can completely warp you. Or you can say, you know what? These people are crude. They're shrewd. They are evil to the core. And you and I will not beat them. Period. That's not a defeated mindset. That's realist. That's logic. That's, hey, look, you can't beat the tax guy. And death seems to be pretty high in terms of probability. So what are you going to do? You're either going to have to get in line with it or avoid it altogether. So I teach you how to get in line with it. And you work out the moral dilemma with doing that. But you can see how we went back into these levels here where there's accumulation, it becomes distribution. Accumulation becomes distribution. Accumulation becomes distribution until we get to the level of sell-side liquidity below the original consolidation. That's beautifully illustrated here with these relative equal lows. And finally on the hourly chart, you can see the turning point up here. Low risk sell, mean threshold, breaks down. Look at the beautiful reactions inside of the old areas of accumulation to become distribution. Look at the bodies. See that? Look at this. And look at that. And look at the bodies there. Do this on your own chart, and I'm telling you, your jaw's gonna drop. It's like, wow, this is real support and resistance in play. Not random trend lines across the chart and hope it works out. This is logic that you can see that is measurable. It repeats over and over and over again. And this tells you, beyond a shadow of a doubt, that there is an algorithmic principle at work here. And you don't need to understand how it's coded. I'm not going to teach you how it's coded. I'm not going to tell you what program language it was done. I get all these questions in Telegram. I'm never going to do that. I can't talk about those things. So I created a language that gets me so close to be able to talk about it and show you things, and I'm not in trouble for doing it. They're not happy because they think I'm going to cross over too far. And I almost did it a few times. But they, for the most part, stay out of my way. But look at the reactions here. Look at the bodies there. What are you going to see right here? Small little what? Volume imbalance? Yes. We trade up into that, wick through it a little bit, but the bodies are turning right at the old area of accumulation. Extend that line on your chart and you'll see it's there too. Comes back down, accumulates. More shorts in here. You get this small little run above into the imbalance, consequent encroachment, boom. Sells off, accumulates more shorts, and then breaks down. Creates a small little imbalance here, comes right back up in, then bang, hits the sell side liquidity. And then you get the reaction here. Rams right back up into the imbalance over here. You can't look at this and say, well, you know, that's random. It's not random. The market refers back to these old areas, not trend lines, not zones that are supply and demand. It's accumulation, distribution, and manipulation. And if it ain't doing any one of those things, it's in consolidation. That's it, folks. That's all it can do. That's all it can do. There's 4 modes of delivery that the algorithm operates on. Period. That's it. That's all it's doing. All you have to do is figure out where it's going to draw to and then read it while it's going in that direction. Sometimes you'll want to trade, sometimes you won't. Sometimes you will trade and you'll lose. Does it change the underlying narrative? No. Then go back in looking for it to deliver the same way you thought it would and risk less. That's the game. That's it. If you did that and tried not to be stupid with your money, you all can be funded and you don't need a job. You don't have to worry about going getting masked. You don't have to be tested. You don't have to get a COVID shot. You can be in your home making all the money you ever want, helping other people because you're funded and they're making money off of you doing it too. That's win-win. Why aren't you considering the opportunities? Wake up. All right, that brings us to the close of this one. And I gave you a whole lot of jawboning tonight. I'm not going to apologize. But this is your homework assignment for Monday's review. it's coffee. I want you to study the December contract, and I apologize I don't have the symbol up here. The symbol you put in TradingView is K, C, Z is in zipper, 2021. Okay? K, C, Z, 2021. You want this low here and this high here. And we want to know why this went up. And you can use this high here too, because that might be a level that it's going to reach for. But we're studying the hindsight move here, this one here, and here. Why did it run from here up to here? That's what we'll cover on Monday. All right, so enjoy your weekend, be safe, and I'll catch up with you on Monday.